pulls a Microsoft. Apple pulls a Meta. Exxon and Chevron are out with their earnings. Is Tesla splitting in two? Bonds continue their slide, and Ken Griffin and Citadel remain undefeated. We've got so much to run through. It's going to be a heck of a day. I mean, let's roll some credits. Good morning, everybody. I'm Mark Sebastian. I am your only option. I am the founder and CEO of OptionPit.com. This is the State of the Market Show. We're here every day at 10 a.m. to guide you through this market. And folks, we're going to have an extra long session today. I'm going to be talking about, obviously, markets. We're going to talk about Apple and Amazon earnings and Apple's China problem. I'm going to have Tim Colby on this morning. We're going to dive deep into the lack of situational awareness around situational awareness and why Ken Griffin remains completely undefeated. Then we're going to be doing a little bit of a dive into free cash flow and what the changes in free cash flow mean. And really, we've talked about free cash flow a lot. I'm not sure everybody knows exactly what free cash flow is. Tim and I are going to kind of give a little explainer on that and then talk about how we're taking advantage of it. It should be a fun one. So with that, let's dig into our markets. Boy, we came out of the gate on a heater. S&P first 4 minutes of the day, just higher. And then could be just the initial burst of buying died out, and we had kind of an overreaction at the end of the day of the markets, or it could be this news that the U.S. Treasury plans to intervene in the Japanese yen market, which will make things quite interesting. Either way, the timing of when we rolled over at 9:35, pretty telling, because we have been essentially straight down since. A little bit of a reprieve there, but markets look weak. S&P is down. The Dow is down. NASDAQ, which was booming higher out of the gate, is now rolled over and in line with all the major indexes. The Russell 2000 is down over 1%. That is a great opportunity for us that we're going to be talking about here in a little bit. And equal weight down $1.50, down 0.7. So we continue to, Amazon and Meta and Google are giving a little bit of gas to the NDX, along with, this morning we're still seeing some strength in. We're still seeing some strength in Micron, although that is pulled up. It is still, trading 840. It is now kind of rolled over to down on the day. And you have SanDisk rolling over. NVIDIA still green on the day. So there's where you're seeing a little strength. Google still green on the day. Amazon, obviously, still green on the day. And Microsoft still green on the day. So you've got some strength coming from some of these names that reported decent earnings, plus Google trying to recover a little bit. But, Apple earnings are out, and they were not great. We're going to hit on those in a little bit, along with Amazon. Just kind of running through what's kind of moving markets on the open. We did have some other earnings that I like to watch. Now, many of you know, I think Reddit does have a pretty nice future in the AI business, but it did not have a pretty nice future in the AI business post earnings. It is getting whacked. And then another name that this will disappoint everybody that's got a 10-year-old or 9-year-old or 8-year-old that likes to play Roblox, because Roblox is also having a rough day. Overnight, or this morning, we did get 2 earnings report from some of the energy giants. ExxonMobil was out with their earnings. Their earnings were great, but as you can see, not great enough. And the stock, which has been on a very nice run, I'm going to go to the day chart, has been on a really nice run, just pulling back ever so much. I don't think this is a big headwind for XOM or CVX. These guys are in line to rake it for the next 12 to 24 months, probably more towards the 24. So, the pullback I'm seeing today is going to present to me a bullish trading opportunity. As long as CL stays in the above 70, things are great. Now, the other real risk to these markets continues to be, on top of Japan, the bond market. And guys, TLT is about to break 82. Like, there is the lack of attention by equity markets to what is happening in the bond market is, I'm flummoxed that at the ability of these markets to ignore it. We now have the 30-year note, the 30-year bond, trading 5.25. The 10-year 4.72. The 10-year is making a run at 5%, folks. That is going to present some real problems. And then, interestingly though, the front end of the curve is we're getting a steepening curve. Don't be surprised if this keeps going, if the Fed doesn't step in and do some twisting. So in twisting, what they would do is sell the front end, which should increase rates, and they'll buy the back end, which would lower rates. That may be in order if the 30-year and the 10-year keep running. Lot of hidden risk here in this market. All right, so let's talk some of these earnings, and I want to start with Apple. Earnings not bad. What I think is just this, it got so overbid and had been run up so much over the last few weeks that they're just taking some of the air out. China sales were disappointing, but all in all, it probably needed to reprice itself down here. It's down about 10%. What actually makes sense? Apple down 10%. Why? Leading into today, it was carrying a PE of about 39. 10% drop. Now you're talking something a little bit more in line with where Apple was. Amazon, different story. And I'm going to ask Tim about this and Hans, but if your cloud revenue is exploding, you got rewarded. Congrats to Microsoft. Congrats to Amazon. And Google, kind of the third, the also ran in cloud. This should be teaching them a lesson, right? Know where the demand is going to be coming from. And Amazon and Microsoft kind of raked on the cloud server side. That really saved their quarters and allowed them to continue to do the hyperscaling investment, whereas Google, which did not have this same kind of cloud run rate, kind of took it on the chin. Amazon is my target for, at one point, to become the most valuable company in the world. At some point. They just do so much. All right, now that I've run through my initial thoughts, let's bring in my good friend, the man who has been with me since day one of my trading career. He is Tim Colby. Good morning, Tim.
Hey, how you doing? Since my day one as well.
Exactly.
It's so good to see your smile. That smile right there you're seeing on the screen. That is the smile that walked in and met me in an elevator in New York City on the American Stock Exchange, going to our first day of work.
There you go. And absolutely. So Tim, initial reaction to the earnings that I just ran through. My take is Apple just need to reprice itself. It had gotten a little overbid.
Yeah.
And
Yeah.
and the cloud, you're in the cloud, you get paid. Those are my two
Totally.
takeaways. What are your thoughts?
Yeah, the cloud is different, right, from this whole idea about the CapEx spend and all this other stuff. So again, Apple is trading a price it traded a week and a half ago. It's still the biggest company in the world. It's amazing. The trend is still pretty well intact. It is a big gap down. Not something to not something to sneeze at. But then you look at Amazon, and that had you got that pulled up there. That's taking out taking out some real prices, right? So that's trading a price back to where it was back in April. This is pretty significant kind of ending of that, what was seemingly a drawdown, which is something that I think we all need to talk about. It is Blue Shirt Friday. I like it after Red Shirt Thursday.
Fridays. There you go.
No, I think that's really important. This idea of kind of hitting, like Amazon maybe hit a low there for a short-term low. Back to your topics on the semiconductors. So I think one of the things that it's really important. I think everybody's here at Option Pit because we're all traders, right? You talked about me and you the first day. I've been together since day one. There's so many things that happen over our trading career. We see these big gaps, like a big gap in Amazon. Like, okay, that was cool, but did that wreck your account? No. Did the Apple move, that big down move and 10% down in Apple, did that wreck your account? No, It shouldn't. And a move like that, a 1 day move, a 1 month move should not wreck your account. And I kind of want to harp on a point that I don't know if enough people are going to talk about this today, but for us at Option Pit, for what we do here as traders, there is a story about situational awareness. And when I first heard situation, we need to talk about that. It's kind of a big deal. But anyway, yeah. So this is, we can talk about the earnings. We don't have a ton of time. I think this segues into sort of what we want to talk about later. But so I don't know where you want to go right now.
No. Yeah. Don't worry. I'm steering the ship. You got nothing to worry about, Tim. Yeah. So far, earnings, in my opinion, we were coming in, Google and Tesla set such a bad precedent. And Apple had been kind of that safe haven play. So when markets are like freaked out, money, the Apple is better than owning a treasury when it comes to cash security. So they kind of pile into Apple. Apple reports earnings that are fine, right? But you can't be fine with the most valuable company and you've run up 25% over the last month. And that's why Apple's taken it. Amazon, just the opposite, right? I think Amazon is going to approach these new highs. It had fallen completely out of the pitchfork that Leisha set for me and is now back in. And with jumping through the very first deviation, I think it's got a clear path up to about 280, 285, and probably hits a new all-time high here in the next couple of weeks, as long as the market doesn't completely roll over.
And we had that same kind of reaction with Microsoft, right? Microsoft was sitting there as under pressure. And it's like, oh, it's kind of a relief. So you have that sort of, little relief rally there. And then the Apple is sort of like, oh, all right, well, what else? We already bought all the Apple we want. It's one of those things. And it gets back to this, this other theme. You have other stocks out there that have been under a lot of pressure, and you have a narrative that's actually being confirmed around with increased CapEx spend, and this whole idea of the AI build out it's been a little bit nervy, and people were wondering, is it overdone too much? And the reality is, there's a backdrop behind that that's bigger than just what earnings are going through. You have a confirmation from the companies that this theme is intact, but you also have a lot of players in the market who are way over levered, and that is having as much of an impact on the price action than the story. And I think as traders, you and I, when we got down on the floor, we didn't really look at the news. We just traded the stocks. Sometimes we would trade stocks. We didn't even know what the stock did.
What they did.
We just traded. Yeah. You kind of traded the math. And so, to this day, as a trader, to me, as important, sometimes almost more important than what a balance sheet looks like, is the market positions. What the market has on matters to me kind of almost more than anything. And then you want to go around with the story. So what is the story? What is the narrative? And so I think that's what we have here, is a picture of market positionings and narrative coming into play, which is setting up, to me, for a pretty interesting spot in the semiconductors. I think we're seeing a near-term bottom in this sort of downtrend that we've seen because of where the market positions are.
Yeah. So now let's talk about the blowing out piece. So everyone knows the ironically named hedge fund situational awareness just dumped their portfolio down and cost their clients 67% of their dollars. And Ken Griffin remains completely undefeated. Literally bought the low tick, and was probably selling the top of the move yesterday. Made a really nice penny. Congratulations, Field Museum. You will be getting another dinosaur in the coming weeks. And this is a great leverage. And folks, if you think this story matter, now you had Korea already putting pressure on markets, right? And then you have rates that are putting pressure on markets. And this trader who clearly did not understand how option positioning can really cause you problems. Getting into some really good stocks that completely blew them out. I mean, do you have that graphic of the from the state of the market from my notes that I dropped in there, or no?
Yeah, let's back up a minute real quick on why. Let's hammer on why this is so important. So there are two sports that I'm involved in. I know it's hard to say play, but there's two things I do that I have significant amount of risk, and they're really fun and they're really awesome, and they actually also mimic a little bit what I do with my job here, trading. Skiing carries a lot of risk, and rock climbing carries a lot of risk. The skiing in the backcountry has avalanche risk, and after every avalanche, they do a postmortem, and they sort of figure out what happened and why did this happen? Because 90% of avalanches that happen are triggered by human beings. And the thing is, going in the backcountry skiing has a ton of risk, and a lot of it can be avoided. The same thing with rock climbing. So one of the most avoidable ways to one of the number one killers of rock climbers that is actually avoidable is one of the simplest things you can do. So when you're rock climbing, you have a rope and you climb up to the top, and then when you're rappelling down, at the end of the rope, you tie a knot so that you don't slip off the end of the rope.
Yeah.
Well, a lot of the very experienced rock climbers will rappel, and sometimes they won't tie a knot in the end of the rope because there's a lot of reasons. Sometimes they could get snagged. Sometimes they don't want to take the time, but they literally will rappel off the end of a rope. It's tragic. It's so sad, but they do reports in rock climbing and in backcountry skiing around these what seem to be avoidable things. They're obvious mistakes that seem to happen, but a lot of times these deaths or these sort of blow-ups happen to experienced people, So it's happening, and they do postmortem because you want to sit back and you want to look at it. I don't want to kind of slam dunk on this kid because, he did raise a lot of money, and he was generally brilliant. Like the guy was a valedictorian at his college. I think it was an Ivy League school at 19. Like, he worked for OpenAI. He was very, very smart. He kind of pioneered this whole idea.
There's a difference between being smart and understanding risk, right? like the guys
Yeah.
what's the book Smartest Guys in the Room, right? Um,
So
it
yes,
all
yes.
Nobel laureates, all kinds of brilliant people, and they blew up billions of dollars. This guy did the same thing, and it's because of the use of leverage, right? Like, so look at this. One, I'm kind of if I'm paying you as a hedge fund manager, I'm a little insulted. Your top holding is an ETF, and not even a levered ETF. But you're seeing option type put. That is a short put, not a long put that this dude had in SMH. Short puts in Nvidia, short puts in Oracle, short puts in Broadcom, short puts in AMD. Owned Bloom Energy. Hey, nice.
So yes.
Owned
So like the
SanDisk.
thing is the
Short
guy.
puts in Micron. Like, you can look at all of these names and then look at what they've done. Here, well, let's just
Well,
look
the
at
thing is,
SMH in the last
yeah. So
few
he
weeks.
had
You can
not
see the
only this,
pain.
he had total return swaps. So he had actually positions on it. We're not actually going to know the real story. Here's the thing that's important for you guys to take away. We're not going to know what really happened, what he really had on. Ken Griffin knows what he had on because he took the position down. The
Yeah.
important point is, here's the thing. He blew up a fund that is going to finish on paper up money. Okay? Listen again. His fund is closing up money in percent terms. Up money. Do you know what that means? That means he looks like one of the greatest investors of all time, and he blew up. That has to do with the fact that he's using leverage. He started with 200 million, he grew, and then he levered. The reason this is so important, I should have just got to this point right away. What's so important for everybody out there, this is going to happen to you. I want you to listen. I'm so passionate about this. I'm like really fired up.
Yeah.
When you start to make money, you're going to make money when you trade with us. I make money. Mark makes money. We've made money our whole careers. When you make money, there's going to be a point when you want to increase your positioning. You're going to want to make your position bigger. I do it right now. This happens. What happened to him happens to me constantly. I'm having this problem happen to me constantly. There's two big things that he did wrong. One is his position was not sized to his thesis. He had a 5-year thesis in a 30-day position. That's wrong, right?
Yes.
5-year thesis. The kid was literally brilliant. He came up and pioneered this idea of don't buy the semiconductor, don't buy the main thing. We're going to buy the back end. We're buying blue energy. We're buying the picks and shovels. He kind of pioneered that idea. Like, that was him. However, he was positioned for that to work tomorrow. He had he just didn't have an ability to take a drawdown. When he had a drawdown, what did he do? He literally called out investors. And he said, hey, this is a buying opportunity. This is the best buying opportunity we've had in a year and a half. He called the low. The problem is, a trader, when you go tell everybody, I think this is a low, I need help, give me a bid. And Jane Street is one of your calls. And then Citadel finds out, guess what? They don't want to invest your money. They want your entire position. They take down your whole position. Ken Griffin isn't the 10th richest person on the earth because he's a nice guy. He's a good trader, right? He knows how to do this kind of stuff. But back to my point with why this is important for you to do a postmortem like they do at Avalanche. Because as you make money, you're going to want to increase your position. And you should increase your positions as you make money. But you've got to be careful because we are trading options. We are trading leverage. We are skiing in the backcountry in avalanche territory. This guy got wiped out by an avalanche. He's not the only one. 300,000 accounts in Korea have been wiped out in the last month. 300,000 accounts.
And
that's insanity.
Think about the leverage in the Japanese carry trade and why the U.S. government is potentially stepping in to do some, call it currency rescue for Japan right now. There are a lot, and then the bond market. Tim, I've said this a couple times. Like I'll just pull up TLT. We are approaching, if not at, multi-year lows in the bond market. And
and you look at the yield, it's
bad. Yeah, I mean, The 30-year is now trading over 5.25. It's 5.26. I can't remember the last. I mean, we kind of sounded the alarm at 5. Now we're at 5.25, and it looks like we might be going to the 10-year looks like it's going to 5%.
Oil is not helping. When we had this rally back in oil, that's kind of what's going on. The Treasuries got smoked this morning around the open. You kind of mentioned that happened around. It's kind of a little fortuitous or maybe just coincidental. But really, the oil, like this, a little bit of it is in Donald Trump's hands, but he's kind of, he's not wanting to admit that we got a problem, or that we. I don't want to get anybody mad. He doesn't want to admit defeat, right? He doesn't want to say lost. He's stuck, and we need crude oil to go back down. That's the one thing that is going to get the bond market to stop going up. In my mind, that is the only thing that will happen. You have got to have oil to go down to have the yields to go.
The only way to get the bond market to start to react is for the stock market to go into full on free fall and people finally race for treasuries for safety. That's the doomsday scenario where the bond market catches a bit as well.
It could. It just has to not happen on the back of crude oil rallying. And don't look for Warsh to go in there and do anything. The guy does not want to. He's not a Bernanke put guy. So he's not coming in to save you. No. That's kind of the big thing. I know we're a little bit over it, but again, the reason you're at Option Pit, the reason you're here, is that you're trading. You're trading with leverage. This is not the first time it happened. This happens all the time. These two things where your position is not sized to your theme in terms of timing. Again, you're using options. So if you have an idea, and I think this is going to play out over the next month, don't put on an option for the closes on Friday, right? That doesn't match. You got to match your position to your thesis, at least in some respect. You can't. How are you going to have a 5-year thesis and then in 1 month you get the first dip to buy, and you get blown out? People were likening him to Warren Buffett. It's like, dude, Warren Buffett, he lives for the dip. Like that's like he's got cash. He's an 80% cash or 50% cash or something. They have 30. I think you have $300 billion in cash right now at a $1 trillion valuation, and he buys the dip. He's the guy that you call, and they takes you out of the position. He bails the market out. So like this idea that the Savant was the greatest hedge fund. No, he was brilliant in AI and he knew what was going on. So you have to do that. You have to rectify your theme and your timing. And then the other part is leverage. As you increase, because again, this guy's his returns on paper are going to be up money. Your account can be up money in percent terms. You're going to say, oh, look, I had all these winners. But if you all of a sudden 4x a position, this happened to me last month. I was increasing my size. I did well in June. I had a really good month, and I'm thinking, okay, I'm gonna increase. And as it happens, as it always happens, I increased. I didn't 4x increase because I felt good. I increased 50% on some trades, 2 times on some trades. And as soon as I get whacked, it's like, all right, I got to back off a little bit, because now I'm starting to be more down money because I'm making bigger trades, right? So, but you got to be very careful about that, because you can look like you're up.
I have a whole speech on how to increase your size, and it's very easy and very simple. And I'll be happy to talk about that, Monday or Tuesday. But long story short, every time if your account goes up 100%, you increase your sizing by 50%. That way, you always are your account's going up at a faster rate than you're increasing your size. That's the way I tell people to do it. All right.
There's so many ways to do it. Yes. All right. Let's move on. Sorry, but it's like somebody died in my mind. Like, I'm sad a little bit, and also to see Ken Griffin win, I'm like, I mean, he wins again.
He's literally the guy that basically killed our entire business, the entire independent market making business. So
you were the person who came over. For him. I remember on the SIBO, you walked over and you said, look at this other side of the trade. Did you do that trade? And I got picked off. I'm all pissed off. I got picked off. He goes, that was Citadel. I'm like, who's Citadel? He's like, they're the one who steals from you every day. I'm like, oh my God, they do. How did you know that? And from then on, I hated them. You introduced me to the Citadel not stealing, but having good, fast algos and picking me off all the time.
Yeah, no, they're the worst. So the next thing I want to talk about, and we talked about this in earnings, is if you look at who got thwacked and who didn't. Amazon's probably the lone escapee because of the growth in their cloud business. There was one overarching theme in earnings so far. And that overarching theme has been free cash flow. Free cash flow has been now the death of the death of big tech is maybe a little overstated, but the point is that we do think that the it's not the death, it's the out of balance returns relative to the rest of the market we think are starting to die. And you've started to see that, right? They're pouring so much money into an outcome that they're not certain about, right? And so what we're going to talk about is like, what is the reason behind the big tech sell-off? We're going to talk about, and I mean, maybe move us side to side to the lower left-hand corner, or do that even better. That's why we love you, I mean. You know, where the billions in AI spend is going, and an opportunity that we see to take a piece of that for yourself. So, just a reminder that, you know, what I'm about to talk about, not investment, legal, or tax advice. Just, you know, you're trading at your own risk. But the real issue, and I've talked about this a few times, the real issue that these big, huge firms are having is their free cash flow. All right. And free cash flow is operating cash flow minus capital expenditures. So I can produce a profit and have negative cash flows. I can produce a huge profit and have negative cash flows. Right? Google broke records for the amount of money they made in a quarter and the amount of revenue they brought in a quarter, and everything's rosy, right? Except then they come out and say our free cash flow was negative. What's $6 billion in negative free cash flow? And that's the amount of cash that a company actually takes in after expenses. All right. So there's a difference, right? There's expenses that, you know, if I buy a piece of capital equipment, I can't write it all off at once, even though I spent that money. Right? So think about this. I buy a Tim and I run a Tim, what company do you want to run with me?
We run a trading company, and we have expenses. We have AI expenses. It could be a new computer we need to buy or something like that. That's really expensive, right? I mean,
sure. So Tim and I run a trading company, and over the course of a year, Tim and I make $1 million. All right. Now, and we're a public trade. We're Citadel. Tim and I run Citadel. It's Tim and Mark Griffin now. All right. We're Ken's two favorite nephews. And we make $200 million in trading profits. However, we spend $200 million in capital expenditures, net, or we spend even more. We spend $250 million in capital expenditures, net. All right, we have negative operating cash flow, but we're able to depreciate only like a third of that expense. So now the cash flow comes out, but our expense is not nearly as high as what our cash was. So we actually show a profit on our books, but our cash evaporated. And so now that explains why a company like Google is selling its stock when their quote unquote profits are firm. Their profits are great. Their free cash flow is not.
For a long time, the sentiment was these were very cash-rich company. They printed money and they sat on hordes and hordes and hordes of cash, and their multiple was sitting on the fact that they could do something with the money, which is kind of funny because now that they're actually doing something with that money, they get a little hit for it.
Yeah, they do. So, I mean, think about this. June 2026, basic net income per share, 1440, diluted 1412. And yet, all right, they're reporting negative free cash flow. Huge earnings, right? If I didn't know better, I would say this is, I mean, look at these revenues. 200 revenues up 20%. I mean, that's amazing. Net income, big. Like, everything about this statement is great. All right. So now here's where things get messy. All right. Free cash flow is a balance sheet number. If you've not heard of it, we don't blame you. I'm going to walk you through a little bit more, all right, about what it is. But let's slide back up to the Wednesday that Google reported. And what you're going to see is everything looked okay. Everything looked awesome. But the more accurate number for these earnings is that free cash flow. And they had negative cash flows for the last quarter. And what it really is do you have money to spend? Do you have money to operate? Right? If I show a profit and I don't have any money, did I make money?
No.
Yes.
I mean,
no. I mean, I maybe reported that I made money, but I didn't. It's a real problem. Yeah. Larry from Texas says, hey, Mark, it's the CapEx effect. Correct. Capital expenditures are really causing a problem.
A lot of it goes on to, it's not necessarily the CapEx is bad, right? CapEx is very good. This is a good thing for companies to do. You want to be able to take that money you have. You want to see people. This is like, instead of investing in research and development, because that's a blind item. If you go back to the other slide, you'll see research and development is a big number, right? But where is it? The third line down, second line down, whatever it is, 27 billion, right? So it's like that number's, you want to see that number. Oh, that was the last one, or 35 billion. You want to see that number because that's research and development into the firm. Well, CapEx, this is sort of, they didn't used to have CapEx like this, and now they do. And the real worry is, well, what is going to be the return on that CapEx? We don't know. It's certainly not what the return was for this company beforehand, right? So they priced the multiple of this company before, and they were printing money with no CapEx. And all of a sudden, well, wait a minute. Now we got a value. What is the value of Google based on the fact that now they are a CapEx company that has like big CapEx? It's okay to have CapEx, but it's really not clear what these are going to be worth. I do think in the long term, they're going to be some of the most valuable pieces of assets on earth, for sure.
Over the long term.
But in the long term, right?
You're also taking a lot of risk now, right? What is the valuation of Google? $4 trillion. And you're investing in a $4 trillion company that has negative cash flows. All right. What type of companies do we invest in that have negative cash flows looking for upside? Is it $4 trillion companies? Well, let's talk about that a little more in a second. All right. The issue that we're seeing is, you had similar issues. Meta, not great free cash flow. Tesla, negative cash flows. Amazon, the one wart on Amazon's number was negative cash flows. All of these major tech firms, not named Apple, are seeing shrinking free cash flows.
It's a thematic shift. It's not
it
something
really is.
That, like, that's the thing. When you look at a company like this, again, like we talked about Berkshire Hathaway before, like that company literally prints money. It literally prints money. and it is just it's a cash machine. And Apple is a cash machine, has been
It
forever,
is.
right? So that's part of the reason you like Apple, because they're sitting on boatloads of cash. And what can they do with the cash? They can issue a dividend, they can buy the stock back. We talked about Tim Cook being, sitting there on his
Yeah.
Charles Schwab account, just buying up Apple stock
Yeah.
with a balance sheet. But when you look at a balance sheet like that with negative cash flow, that's not you should be looking at not a mega cap. You should be looking at something else, right? Because you're starting to mirror.
Right. And I'm going to talk about that in a second.
Yeah.
Yeah. So, Tim, here are two stocks, and you can probably figure out the first one, but I like to run this ratio. It's market cap to free cash flow. So, stock one is worth $4.1 trillion. They produced a profit of $244 billion in the last 12 months. And then a negative free cash flow of just under $6 billion. Stock two has a market cap of $1.91 billion. All right. Last 12 months, they had a profit of $18 million. Yet, they had a free cash flow number of $620 million. So that means on our free cash flow ratio, stock one is we'll politely give them a 0 instead of a negative number. Stock two, which everybody's ignoring, for every dollar in that market cap, 32% of it is positive cash flow coming into the company. That tells me that company is sturdy. And in
three goes of that round, you could rebuy the company, right?
Yes. And this company actually raised their free cash flow guidance on their last earnings report, which is even more bananas. So, and here's where our greater point is. All right. Smaller caps typically have smaller free cash flows, and mega caps are supposed to have huge free cash flow numbers, right? And Google and Microsoft and Apple and Amazon 3 years ago, before the AI boom, right? Let's go back to where can we see here? Take a look at Meta. All right. And compare that where they were. All right. 6 months ended June 30, 20. The free cash flow number this time last year was $18 billion. And now it's $784 million. Look at the move that we've seen in Tesla, right? From 3.9 billion down to 1.4 to negative $1 billion. Amazon has rolled from a free cash flow of over 28 million or 28 billion to now a negative free cash flow. Again, Amazon, the cloud business, that's kind of bailing them out here because people can actually see that negative free cash flow is actually starting to pay dividends, because I don't want to get into Amazon right now, but you get my point. So these free cash flow numbers, you're paying the trillions of dollars for these companies because they're cash machines. Your money is safe and there's growth. All right. That has flipped. These hyperscalers, they're pouring huge money into risky investments. All right. Sans Apple and NVIDIA, right? NVIDIA, they're one of the people selling to. Why did NVIDIA make its huge move? Because they were selling to the hyperscalers. Why has Apple done well? Because they said, you know what? We think we want to be your end user and not a creator.
Yeah.
But these companies are pouring. It was brilliant. I mean, I blasted Tim Cook at the time. Tim, I am sorry. They're pouring money into AI and data centers. So what small caps provide is two ways that they're beneficiaries of what's going on in the AI boom. All right. Small caps are the picks and shovels. Think like, Tim, SMR. That's a pick and shovel, or an Oklo. What are,
Yeah.
throw out some of your pick and shovel names that you know.
You stole two right off the top of my head. No, really, I was going to say SMR. I was looking at I have a position in SMR. All of these smaller companies. I think before we go there, but you have so that investment, right? So I think the point is when they're doing this capex, that's because they expect a future return on it. But what is the return on that money? So if you have a $4 trillion company and they're going to spend $1 trillion, are you going to 10x that? You're going to 10x $1 trillion? Like, maybe you're going to 10x to you're now going to be a $20 trillion company. Maybe.
I mean,
but Mark, do you really think, like, is there like, we're talking about crazy numbers, but things that make sense if you start to think of some of these small companies that have capex, like an SMR or Oklo or the companies that I love. Everybody calls me Quantum Tim, but I love the quantum stocks, right? They have, all these companies, Quantum. The point is the investment that they're going to put in, they're going to be spending that ratio on a smaller company, right? I don't want to take away your thunder here, but the idea
that's exactly
is
right. That's exactly right.
If I look at the balance sheet of a small company and they got, I don't know, their ratio is sort of similar to Apple or similar to Google's, but I think that they can put up $1 billion or $10 billion. That's a real number that, like, I don't have to do macro math to think how many people are in the world and how can you possibly generate $10 trillion worth of money. Like, some company that's small, that's up and coming, can generate, it could be a $1 billion company to a $20 billion company. That's a 20x. And all they have to do is, they put their money to work. There's just, if I'm looking at two sheets, I want the one that has real possible upside.
Right. And that's why, we love these picks and shovels. And then the other end of it, right? Think Apple, but think the actual ability to grow itself 20x. All right. These are the companies that are on the other end. They're the customers of the hyperscalers that are using the resources that the hyperscalers are dumping into AI to actually make money and grow their businesses. They're the actual beneficiaries. So, you've got this cog in the middle, this massive arms race, all right, to build out AI and build the best model. Who are the winners there? The suppliers and their end users. And so Tim and I, me in particular, I see value in being able to be an end user of AI or a pick and shovel, and because they're able to produce a positive free cash flow out of that, or if they're not right now, the investment actually has the opportunity to go 20x. And I'm going to show you an example of that here in a couple seconds, but I want to show you a couple of the trades that I've been doing in my option pit small cap portfolio. All right. This is USA Rare Earth. Now, this is one we love here. And we have, Frank was the one that was their initial investment banker. So we do have a little bit of personal bias, but I'm in the middle of my third trade of USAR, and I've gotten 147% and 153% on two trades, right? I invest in these, but I'm also, unlike what happened with our friend's situational awareness, when I see that these companies have gotten overextended, I get out and then I reposition once they've gone back down to earth. USAR is one that I have just started to buy pretty aggressively down here. And it is eventually going to hit 35 and actually stay there because they're going to open their mind. There's a lot behind this. Here's another one. Teradata Corp, system management, AI agents. All right. Automation and unstructured data. Gee, end user, right? 205%, gets overextended. I sell out, pulls back, I get back in, runs back up 133%. Oh, lo and behold, it's pulled right back. Guess who's ready to get back into a name like Teradata Corp?
You either have dry powder, or you're actually a trader who sizes your position and takes your profits when you need to take profits. So you don't just, when it goes up 133%, you don't 4x your long.
Correct. All right. Now here's another one. This is one that we did well, and then I kind of missed this move. But what I would say is, it's pulled right back to where I'm kind of interested in playing again. Semtech gets down into the 90s. That's a level where I'm interested in. Now they do chips, they do cloud management. They kind of are a connector. Think of like a baby Cloudflare. A really interesting name on the communication side. And then here's a stock that and this is what I mean by they can 20x. This is one that we put money in and absolutely exploded. And you can see what the name of this one is. It's SanDisk. We bought SanDisk in October of 2025. Now, my only regret is that we sold SanDisk in December of 2020, in January of 2026, and we only made 175% on our trade. But we are able to ride these names. Here's the entire track record of where we are. I'm sorry, SanDisk 140%, TDC 205. Do we have losers? Yes. We're using options to give you the leverage to mimic the stock without you having to dump in to carry a $100,000 portfolio, but we're sizing things appropriately so that everybody's able to get involved. And year over year, the S&P 500 stock right now, the stock market's up like 8% on the year now. NASDAQ's, which had a great year, not up what it was. Since we launched this in October 2025, we're up 40%. Even with all of our wins and losses, we're up 40% in the portfolio. I'll bet you our friends at Situational Awareness wish they were up 40% in their portfolio. So what Tim and I want to do is invite you to join us. All right. We want you to join Special Situations Unlimited. You get to trade the most exciting events in the market every single day. I'm going to be meeting with Special Situations and Special Situations Unlimited here in about a half an hour, and we're going to be doing what I call my post-earnings trade. We're going to take advantage of the dive in option premiums after earnings when they get oversold to find some opportunities to trade. We do Fed meetings, mergers and acquisitions, volatility anomalies. You're going to get
it's not just this portfolio. This portfolio is something different, right? So this is another thing that you get with Special Situations. Yes. And again, these trades come from all of us. So Andrew puts them in, Hans puts them in. I'm a little shy because I don't have my service going, which is coming up in the next few weeks. It is.
Yes.
But you get this from all of us.
Yes. You get buy and sell alerts on all new trades. You get a custom calendar, monthly live meetings. And then Special Situations Unlimited is the only membership that gets access to the Option Pit small cap ETF. And if this will get you, if you couldn't be more excited about what we're going to do in small caps with these great reset in price out of the Russell 2000 and this huge opportunity to get into some of these names at with free cash flow where it is. We are going to be adding a second portfolio here in the next couple of months. All right. Quantum, do you want to tell them what type of portfolio we're going to be adding, Quantum?
We will be adding a quantum portfolio. But what's interesting about the names that you want to add here are not necessarily different from before, but there's a theme that you're running with. Some names are going to get added, and it's a set of stocks that actually have positive free cash flow, which is rare for these small cap stocks. Right. So it's from a list of companies that scan through, positive free cash flow, which is abnormal. All these other stuff, loads of these you expect a small cap to have negative cash flow, right?
Yeah. Now here was a great question. Surf Jackson, what's the free cash flow on USAR? See, that's the thing. You don't mind negative free cash flow on a company that is $4 billion that could go to 50. Right. The upside versus the downside. Google is 4 trillion negative free cash flow. If they roll this over, where are they going to go? Even if they double, they're not going to equal the performance of owning USAR going from 4 billion to 50 billion. So it's about time. It's about understanding the investment risk. And that's why Tim and I like small caps so much right now. And only special situation gets the unlimited. All right. Or only special situations unlimited gets the small cap portfolio. And when we do this quantum portfolio, that will only be within special situations unlimited as well. But special situations, if you want to trade just these post-earnings trades with me in about half an hour, $19 to try it. But it doesn't include option pit small cap portfolio. So to me, the $12.99 is an absolute screamer of a deal. You can click the link that they've dropped here or give the team a call, 888-872-3301. I'm going to be adding 2 stocks today, this afternoon at 1:30 p.m. Eastern time. So make sure you sign up, give the team a call by then, take advantage of this portfolio. It's going to be a lot of fun. And thus far, traders have been extremely happy with how we have performed with this portfolio. Other questions for me? I've been looking forward to this introduction for some time. Let's go. All right, Blue H2, come on in. Yes, USAR does have negative cash flow. We're fine with that. It's negative cash flow isn't bad. It is bad, but it's not awful when you're starting a company, when you're at the onset. Where negative cash flow is a problem is when you're Google and you're the second or third most valuable company in the world and you're producing negative cash flows. So Google's now got all this debt risk, and my hope is maybe that stock doubles. USAR has debt risk, and my hope there is that this one 10x's or maybe 20x's if everything goes right.
Yeah, and so that's the takeaway here, is that not all of these companies, that's the one takeaway, is that you have a portfolio of these companies where they're going to have negative free cash flow, and you might as well be buying, you're going to buy anything, buy something like this. You don't need to be buying the mega caps. In addition to that, there are going to be companies that we put in here, some of the newer ones that we have now that we're sort of seeing how much the market's hating these upper mega caps having negative free cash flow. It's like, well, let's go find the ones that are the small caps that have positive free cash flow, and then also are going to be a beneficiary of the CapEx spend from the mega caps. They're spending in areas where these other little companies are going to benefit from.
Yeah.
And that's kind of the big takeaway here.
All right. So they should be there's a post to join me in special situations kind of floating above the top right there. And I'll drop the link in chat here for you guys to join us. So I would love it if you join us. If you've got questions, you want to know if you've got credits, give the team a call, 888-872-3301. That's 888-872-3301. Take advantage of this, guys. We only open up the unlimited access every so often, and we're doing that right now. Normally, special situations is only available on the monthly. And so when you take this opportunity to get back into this unlimited, we've had this repricing in the market, and I'm looking at a lot of these names that I see upside that some of which do have free cash flow, some of which I see, 10, 20, 30x. And this is your opportunity to join me. So click the link or give the team a call, 888-872-3301. Any other questions for me or Tim? Yeah. Crazy Bird says free cash flow is non-existent in USAR, correct? But that huge government backing is priceless. You're not wrong on that, Crazy Bird. USAR is one that we really like, and quantum ones are really interesting. Yeah. All right. Any other questions? And folks, we're not saying Google's a bad company. We just see more growth in these smaller names and more upside.
Yeah, it's a way to diversify out of just the same old kind of. If you have indexes, you already have these companies anyway, right? I mean, there's a whole. It's the Russell 2000. There's 2,000 companies, and you don't want to own them all, right? That's
right. Is this included in Trader X? Yes. How's the current portfolio doing? I literally almost went to cash when we pulled back. When we had this pullback, and I saw these names all getting overextended. I literally kind of went to cash, which is why I'm adding between 5 and 7 trades. Right? Normally I carry a portfolio of about 7 to 8 trades. I have 2. So that puts you, that's why this is almost like a complete reset of reset opportunity to get back into this small cap. That's why the timing is so perfect, right? We're looking at where the Russell is right now, where we are in this rotation, where the opportunity is, and we're about to go strike the hammer. I'm going to add like 2 names today and probably 3 or 4 and another 3 or 4 next week. How many trades do you get with special situations? Typically about 4 to 6 a month. Typically about 4 to 6 a month. That can vary, right? There might be some months where there's 2. But with my post-earnings trades, I'm going to do probably 7 trades over the next 2 weeks.
It'll come in chunks. And a lot of times they'll come in, again, special situations. It is kind of, that's the name chosen because they are trades that generally are not going to fall within a service. It's something that we see, something you want to do, and it just wouldn't fit a normal service. And that's where these trades.
These are trades that we think are consistently profitable and teachable, but maybe not. They don't repeat with the frequency of like what we see in Delta Strike or what Tim's upcoming trading is gonna be called, or any of those. Are they all listed? Yes. Yes, they are. All the trades will be listed in the special situations portfolio. Those will be coming out again today at 1:30 p.m. Eastern time. I invite you to join me. And again, if you got questions, give the team a call, 888-872-3301. If you just want to try out these post-earning trades, it's $19. I can't feed my kids. I can't feed my 2 kids, a Happy Meal and a double quarter pounder with cheese and 2 McFlurries for $19. Literally. Does Unlimited? Yes, Mike. Unlimited has access to the Option Pit small cap portfolio, which is going to be the trades I'm adding at 1:30. And if and when we launch Tim's quantum portfolio, that will not be regular special situations. That will only be special situations unlimited. So yes, there are some big differences.
And the other thing with the portfolio that's going in there, it's not just here. I mean, you could just hear the names, but there's trades that go around them, right? So there's some of the ways you trade them, some of the options you pick, some of the strategies that go on to those names to generate that return. Also, sometimes it's not just a simple buy that one stock.
Yes. All right, folks. I hope you take advantage of this opportunity with special situations unlimited. Click the link, or you can call us 888-872-3301 and my customer care team will take extra special care of you guys. All right. All right, everybody. Tim, thanks so much for your time. Folks at home, thanks so much for your time. So for Tim Colby, our head macro trader, I'm Mark Sebastian. I am your only option. Thank you for your time with me. And as always, thanks, Amin.